This is Nightly Business Report with Sue Herrera and Bill Griffin.
Trade in focus. The U.S. reaches a deal with Canada and Mexico over metal tariffs, but an agreement with China may have just hit a snag.
Oh dear, the company warns of weaker earnings because of the trade war, and the heavy rains in the Midwest aren't helping either.
New perks. Restaurants are cooking up new ideas to attract workers and get them to stay. Those stories and much more tonight on Nightly Business Report for Friday, May 17th.
Good evening, everyone, and welcome. Wall Street cares about trade. Today's session proved it. Stocks moved higher when the U.S., Canada, and Mexico reached an agreement on steel and aluminum tariffs. But then stocks headed in the other direction on reports that talks between the U.S. and China have stalled, leading to concerns of retaliation, which could hit global growth. Kayla Tausche starts us off tonight in Washington.
In the Trump administration's multifaceted trade fight, progress on two fronts, stalling on the other. Today brought news that the White House would lift steel and aluminum tariffs on Canada and Mexico, two close U.S. allies whose support President Trump needs for the new NAFTA.
So that deal is going to be a fantastic deal for our country, and hopefully Congress will approve the USMCA quickly.
Today's deal lifts tariffs in the next 48 hours. It ends retaliation against U.S. products like beer kegs, whiskey, and pork, and drops bitter lawsuits over those actions in hopes of clearing a path for the trade agreement. Canadian Prime Minister Justin Trudeau expressed confidence.
Now that we've had a full lift on these tariffs, we are going to work with the United States on timing for ratification, but we're very optimistic we're going to be able to move forward.
The White House shelving another set of tariffs, this time on automobiles, with a decision delayed up to 6 months while it negotiates with Europe and Japan. But Trump hasn't ruled out those charges entirely.
They take advantage of us on trade. It's not fair. We lost $180 billion with the European Union.
Republican lawmakers who have sought to persuade the president against tariffs sounded their support. In a statement, Nebraska Senator Ben Sasse said, quote, "China is our adversary. Canada and Mexico are our friends. The president is right to increase pressure on China. He's also right to be de-escalating tension with our North American allies." In what Sasse called the Cold War with China, sources say talks have stalled as Washington and Beijing double down on their positions and discussions over the next round of talks in flux until they can agree on what they will talk about. For Nightly Business Report, I'm Kayla Tausche in Washington.
And trade headlines continued to inject more volatility into the market. At the close today, the Dow was down 98 points, closed at 25,764. The NASDAQ slid by 81. The S&P was down 16, and the Dow registered its first 4-week losing streak in 3 years. Bob Pisani takes us through all this week's twists and turns, and he looks ahead to next week.
It's never a dull moment on Wall Street, you know. First, the Dow Jones Industrial Average plummets more than 600 points on Monday after China announced a retaliatory round of tariffs over the weekend. Seems like a long time ago. Then the market edged higher on Tuesday on hopeful comments from Steve Mnuchin, Treasury Secretary, and President Trump, saying trade talks have not completely collapsed. Stocks have pretty much bounced up and down on every trade tweet and headline that's crossed the wire since then. But look what happened today. We're holding up well on good economic numbers and a little more trade talk hopes. Just prior to the open at 8:30, word came out that the White House was officially delaying the tariffs on European auto imports. That's good news. Then after the open, we rose more on reports the White House could lift those steel and aluminum import tariffs from Canada and Mexico. That was confirmed. But after all these trade disappointments, it's getting tougher to sell the trade story. That's why we're not getting a big bounce from industrial stocks associated with trade like Caterpillar or 3M, or even some of the tech names like Apple or Intel. Intel's had an awful month so far. One other trade-sensitive group that's had an awful week is retailers. They finally got a modest lift, but names like Macy's and Kohl's, they're still down 2 to 4% this week. Gap's down 8%. Next week's going to be another very busy one. We'll get earnings from retailers like Home Depot and Lowe's and Best Buy. Any commentary on China or tariffs could be key. Foot Locker is a big one. 70% of U.S. footwear is imported from China. 70%. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
There's trouble on the farm, and it is affecting Deere. The company lowered its earnings and revenue targets for the year, citing both the trade war and the lousy weather in the Midwest. The tractor maker's disappointing results sent the stock down more than 7.5%. Morgan Brennan has more on Deere's 1-2 punch.
Deere cutting its full-year outlook as bad weather and a trade war with China threaten to further hit farm incomes, and with them, demand for Deere equipment. The maker of green tractors and harvesting combines now expects equipment sales to rise just 5% for the year, down from a previous forecast of 7%. In a statement, CEO and Chairman Samuel Allen saying, quote, ongoing concerns about export market access, near-term demand for commodities such as soybeans, and a delayed planting season in much of North America are causing farmers to become much more cautious about making major purchases. Nearly 60% of Deere's sales come from North America, and for farmers here, it's been really a 1-2 punch. Escalating trade tensions with China, a crucial export market for U.S. agriculture, have sent soybean futures to a 10-year low. And cold, wet weather in the Midwest, including historic flooding in some places, has delayed farmers' abilities to plant crops. That's weighed on demand for Deere, the reason J.P. Morgan downgraded the stock to underweight ahead of today's results.
They have to now actually underproduce retail in the back half of the year because their dealers have too much inventory and they have no visibility into 2020. So we don't know if we're going to have to continue to underproduce into next year or whether things will be right-sized by the time we get to the end of this year because there's so much uncertainty out there.
Deere telling investors today it is not currently betting on a trade resolution. The reason it's now planning to cut production of farm equipment by 20% at 2 of its North American factories. A fifth straight miss on earnings and dampened outlook sent shares of Deere lower, adding to losses that have only accelerated in recent months. For Nightly Business Report, I'm Morgan Brennan at the New York Stock Exchange.
Now, as we reported, the U.S. and Mexico came to that agreement today on steel and aluminum tariffs, but the two countries are still fighting over tomatoes. And this trade skirmish will cost you. Jane Wells explains.
Fresh tomatoes are a $4 billion business, and half the crop we eat comes from Mexico. But American growers, mostly in Florida, claim they're suffering, that the current tomato situation is rotten. They say Mexico is using loopholes in our trade agreement to dump product here, and now the Commerce Department is investigating and bringing back an old tariff of about 18%. Mexico says prove it.
You can't just say somebody's cheating.
Robert LaRussa represents Mexican growers. He calls Mexican tomatoes the best in the world and likens them to the Golden State Warriors.
Nobody beats them, and that's because they are the best in the world. They have the best players in the world. If somebody just says they're cheating, they'd have to have something to back that up. It's the same with Mexican tomatoes.
Some small Mexican growers are now saying they're going to stop shipping tomatoes north because their U.S. import operations cannot afford now to put up the cash bond to cover the potential tariff until the issue is decided. Well, what does that do to prices? So far, they're up 2% at the retail level since this started. They're up 10% in a year. And companies like Chipotle buy millions and millions of pounds of tomatoes. But they're telling us since they contract out, they don't expect an impact. They don't plan to raise prices, and they may not have to. Mexico is suing in U.S. court to make this all go away. At the same time, both sides continue negotiating a new trade deal to remove the tariffs, which might include things like a higher floor price for selling the tomatoes. And while the tariffs are back, they're not yet going to the U.S. government. They're being held in escrow until there's a final decision on whether or not Mexico has, in fact, been cheating. But wait, there's more. We may get half our fresh tomatoes from Mexico, but we get 80% of our avocados from there. And avocado prices are way up ever since the president threatened to close the border. Now Reuters reports there's another country thinking of sending fruit here to potentially close any guac gap. A country we're hearing a lot about during these trade wars, Vietnam. For Nightly Business Report, I'm Jane Wells in Los Angeles.
It is time to take a look at some of today's upgrades and downgrades. Under Armour was upgraded to overweight from neutral at J.P. Morgan. The analyst cites the potential for gross margin expansion. The price target is $29. The stock rose more than 7.5% to $23.58. Foot Locker was upgraded to buy from neutral at B. Riley FBR. The analyst calls Foot Locker a best-in-class footwear retailer. And as Bob Pisani mentioned earlier, it reports its earnings next week. The price target is $54. Despite the upgrade, though, the stock fell a fraction to $55.20. Baidu was downgraded to hold from buy at Deutsche Bank. The analyst says the company's growth is slowing more than expected and it's losing market share in advertising. The price target is $147. The shares dropped 16% to $128.31.
Still ahead, getting schooled.
States are threatening to crack down on for-profit colleges after the Trump administration eases regulations. What does that mean to these schools and their students at a time when skilled workers are in short supply? I'm Scott Cohn in Silicon Valley. We'll have the story coming up on Nightly Business Report.
Consumer sentiment is at a 15-year high. The University of Michigan points out that its survey was done before that escalation in trade tensions between the U.S. and China, but added that most of the optimism comes from the strong job market and rising wages.
And as you know, that tight labor market is making it difficult for companies to find the right workers. Just today, the head of the Philadelphia Fed said that our country is running out of people to hire and it needs creative solutions to deal with the problem. And as Kate Rogers reports now, that's exactly what some in the restaurant industry are doing.
This isn't your typical job interview. It's a party, a hiring party, that is. Taco Bell hosted 600 of them last month nationwide to attract new workers in the face of a historic labor crunch.
It is very tight today, and we wanted to do something different to help us stand out among competition because it is extremely competitive for great talent.
It's working. The company says it's seen about a 40% increase in applications from a year ago from people like Tiffany Thornton.
A situation like this allows for people to actually be able to come together, show themselves, their personalities, their strengths, attributes, attitudes, and possibly get a job.
Brands are thinking outside of the box to attract workers. McDonald's recently announced a partnership with the AARP to fill 250,000 summer jobs. Shake Shack is testing out a 4-day work week for managers, giving added flexibility. It's also about retention. Chipotle says more than 80% of its general managers are homegrown, and last year it promoted over 13,000 employees. Benefits include bonuses and tuition reimbursement. Starbucks offers full tuition coverage through its college achievement plan, along with paid leave, as well as stock options for eligible workers. Some franchisees are also investing more in training to keep the workers they hire on board. The Wolak Group, which owns nearly 100 Dunkin' Donuts locations, built a facility in 2017 dedicated to training as well as putting a new orientation program in place.
When you look at turnover within the industry, traditionally, it's well over 100%. We were not satisfied with that as an organization and tried to take a very broad strategic look at what things we could do to improve our training, improve our workplace culture, and those are the things I think now that we're seeing with a lower turnover percentage that are really having an effect for us.
The group says it's been a success. Turnover fell dramatically last year, and in this labor market, hanging on to those workers is good for business. For Nightly Business Report, I'm Kate Rogers.
In an era of acute worker shortages, can America do without for-profit colleges? Officials at the colleges say they're needed and that after years of scrutiny, they've learned their lesson. But students at these institutions are more likely to take out student loans than their nonprofit counterparts and graduate with more debt. Scott Cohn is in Silicon Valley for us tonight.
I really need to figure out the money thing first.
The stories are cringeworthy. In this federal undercover investigation from a decade ago, agents posing as students found aggressive sales tactics.
You owe it to yourself. Finish your paperwork, apply to the school. This is your admissions and application process.
Getting them on the hook for student loans.
No one here has not gone to school because of financial aid.
All for an education with limited job prospects. Major reforms followed, but even now schools are shutting down, leaving students in the lurch, including Argosy University, abruptly closing in March.
A lot of us are frustrated and hurt and angry because what do we do?
But the CEO of the nation's largest chain, the University of Phoenix, says the industry has largely cleaned up its act, making huge changes. The university's parent company took itself private in 2017 and began slashing programs where graduates weren't getting jobs.
We evaluated all our programs and we got rid of most of our associate programs, and we had to get rid of some of our largest programs, which was tough for the university.
The for-profit colleges had little choice but to change. Under an Obama-era crackdown, they risked losing access to federal aid programs if their graduates weren't finding gainful work. The Trump administration has reversed that, but the colleges are not out of the woods. States are weighing in with rules of their own, including a bill under consideration in California to reinstate the Obama standards in the state.
It's the for-profit colleges that have received a tremendous amount of federal resources that have had very little oversight. And the numbers that we're talking about have been worst with for-profit colleges.
For-profit college students are more likely to take out loans than their traditional college counterparts, 83% on average. They graduate with more debt, nearly $40,000, and nearly half are defaulting on their loans, compared to 28% overall. The University of Phoenix says all of its programs meet the Obama-era standards, and its loan statistics are now comparable with traditional schools. But the CEO worries about a patchwork of state laws.
I would urge states, and I would urge the federal government to come together and think about if there needs to be some formula to assure that good players in higher education have an opportunity to serve adults who need this education.
At a time when businesses have a voracious appetite for educated workers, for-profit colleges are not going away. For Nightly Business Report, Scott Cohn, San Jose.
Luckin Coffee gets a caffeine jolt in its opening day of trading, and that's where we begin tonight's market focus. The Beijing-based chain surged in its trading debut on the NASDAQ, up as much as 53% at one point. While Starbucks is celebrating its 20th year in China, Luckin is trying to overtake it as the biggest coffee chain there. The CFO laid out how the company can compete, though, with the likes of Starbucks.
Everything is cacheless, which means that we have all the connection with the customers and data. That's point one. I think point two is we're using technology. Technology is for us very important, which makes our operations efficient, lower wastage, and also very good quality control. And I guess the last point is where we're different is when you think about our store footprint, we're using very small stores, right? Rental, decoration, we save a lot of money. We're very close to our customers. And if you look at those three together, that's kind of what we call the new retail model.
Shares finished up nearly 20% today to $20.38. Another company that made its debut on Wall Street today was content distribution network Fastly. While its competition includes Google and Amazon, the company's founder and CEO talked about the importance of cloud computing.
As customers are migrating to the cloud and they want to do a multi-cloud strategy, which the prediction is by 2022, 90% of enterprises will have a multi-cloud strategy. They need a replacement for their old edge inside their data center. So where you enforce security, where you enforce compliance, where you do load balancing. If you go all in on one cloud provider's solution, you're really locked in to that cloud provider. So we're kind of a neutral third party in that ecosystem.
And shares rose nearly 50% today to $23.99. Meanwhile, JPMorgan Chase is buying medical payments technology firm Instamed for more than $500 million, making it the bank's biggest acquisition since the financial crisis. The move strengthens JPMorgan's push into the healthcare spending market. JPMorgan was off a fraction today to 110.77.
Hewlett-Packard Enterprise is buying supercomputer maker Cray for about $1.3 billion in cash. The move is part of the business technology giant's efforts to invest in high-performance computing and sell supercomputing products to its commercial clients. Hewlett-Packard Enterprise was up a fraction to $14.62. Cray rose more than 22% today to $36.52. Amazon is buying a stake in British delivery service company Deliveroo. and it becomes Deliveroo's largest shareholder. The move takes aim at popular food delivery services like Uber Eats. Shares of Amazon fell 2% to finish at $1,869. And the ride-sharing company Lyft is being sued by investors over its IPO. The lawsuit claims Lyft misled investors about its ride-sharing position, bicycle safety issues, and labor matters. It also alleges Lyft's false statements inflated the company's share price, in which investors lost money when that price fell. Lyft fell more than 3% to finish at $53.79.
Time now for our weekly market monitor, who is betting on the U.S. consumer. Quint Tatro's back with us. He's founder and president of Jewel Financial. Welcome back. Good to see you again.
It's good to be here.
And the first one you bring up for us, if you're thinking about the consumer, is Twitter. Now, I don't often think of that as a consumer company, obviously a technology company. How does that fit in?
Well, the consumer, or the American people, really have this appetite for news and what's happening out there. And so this is not necessarily a place that they're going to go and buy things, but they're going to go there to understand what is going on in the world. We are seeing this through the trade and tariff agreements, or lack thereof. There isn't a person walking around who isn't aware of the Trump tweets. Yet, most people do not think of this as a viable business.
Because it has had trouble monetizing this user.
That is
right?
exactly correct. And what we have seen is that this company has made a tremendous transition fundamentally. The last quarter, they were significantly profitable with extreme cash flow, which we like to see. We like to look for companies that are growing, that we can buy at a reasonable price, and Twitter is one of those names.
And Walmart you like as well. They just came out with their earnings the other day. Online sales were up better than 35%.
Yeah, Walmart is a staple for us. I don't think this is one that's going to nearly be as speculative as a Twitter. Therefore, we might not get the same upside. It's trading pretty high as is compared to its valuation. But we like what Walmart's doing to go after the market share through e-commerce, one-day delivery, and the numbers that they brought out are exceptional. And the company yields 2%. So we're getting paid to wait for them to continue to take market share in that space.
Then in the financial services industry, Capital One, familiar name. I looked at a chart today, and you go back to 2016, and the stock is essentially right where it was 13 years ago before the financial crisis. But I assume you feel it goes up from here, beyond its lost decade, if you will.
That's exactly right. Well, one of the things we like to look at, that you brought that up, is how has a company done in relation to their stock price. Despite going nowhere in that stock price, that company has continued to improve its overall value. But what we like about Capital One, many financial companies are undervalued. That's true across the banking sector as a whole. But Capital One is making a big move to the online space to really try to get that younger generation, and they're doing a great job at it.
Very good. Quint Tatro with Jewel Financial. Always good to see you.
It's great to be here. Thank you.
Coming up, fixing our nation's infrastructure.
I'm Aditi Roy at the Port of Oakland in California. Infrastructure spending on U.S. ports is at an all-time high. Coming up, I'll show you what's behind it and why there's still a need for more.
The Port of Oakland is one of the major hubs for goods traveling between the U.S. and Asia, so you might think that it would be feeling the impact of the trade war with China. But that's not the case. And as you saw there, Aditi Roy reports she has the bigger issue for the port is the upgrading of its infrastructure.
Business is booming at the Port of Oakland. The last 2 years, the port has moved record volumes of cargo, nearly $57 billion worth last year alone. The swell in business is attracting investment dollars. The port is in the middle of a 7-year, $1 billion program for infrastructure development.
The investment is necessary because cargo volumes are growing. Customers are getting more demanding. We need to enlarge and improve our ability to handle cargo so we can keep that cargo coming to Oakland.
Part of that money will go towards a $55 million warehouse and distribution center about to be built. And last fall, this $100 million facility, which allows perishables to be stored while in transit, just opened for business. Company President Jason Dreisbach says it was a not-to-be-missed business opportunity.
There is definitely a need from the customer standpoint to have a refrigerated transload to control the quality of the food products, and obviously its location right here in the heart of the port made it ideal for transiting the products out of the rail into the ocean containers.
Nationwide, there's a similar boom in infrastructure spending at U.S. ports. The American Association of Port Authorities, or AAPA, found infrastructure spending between 2016 to 2020 increased threefold compared to 5 years prior. That's due in large part to the U.S. lifting its ban on crude oil exports in 2015. Since then, there's been a construction boom at the ports along the Gulf of Mexico to handle the extra volume. Still, needs remain. The AAPA last month asked for $66 billion worth of federal funding for port infrastructure projects to help move cargo in and out of ports more efficiently. The threat of tariffs also looms high for some port businesses, which say long-term tariffs could impact growth.
It definitely has an impact on us. We're really hoping that a trade agreement gets reached.
Still, officials here at the Port of Oakland say that the strength of the U.S. economy, combined with the rise of the middle class in Asia, has helped soften the tariff impact. For a Nightly Business Report, I'm Aditi Roy, Oakland, California.
And before we go, here's a look at these Friday final numbers on Wall Street. The Dow fell 98 points to 25,764. The Nasdaq slid 81, and the S&P 500 was down 16. The Dow registered its first 4-week losing streak in 3 years.
Wonder what
one of those weeks.
And I wonder if what next week brings with the trade headlines as well.
I don't know.
Should be interesting.
It sure will. Okay, that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great weekend. See you on Monday.